Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We do need to rethink the narrative that we've been coming in with. The economy is, forget soft landing, maybe we're having no landing. That's what this jobs report may be telling us. I think we'd all sort of thought mission accomplished on the stable prices part of the dual mandate, and on top of it, you had monthly hourly earnings rise more than expected. So this is tough if you're sitting around waiting for massive rate cuts.
These high rates have kind of worn out their welcome, so if we get some lower rates here, that will help stimulate some of the loan growth, which has been very, very weak. That will help take some of the pressure off deposit costs, which have also been elevated for banks, and then kind of helps with the increasing the odds of a soft landing.
We do expect it's more likely to be a sell the news event. I think there's been a lot of hype into this event. We've seen the stock move up. Investor expectations are quite high in terms of the promises that are going to be made at this event. We think that a real credible path to robo-taxi commercialization in the next 12 to 24 months is extremely unlikely to come out of this event.
We got 1 hour to go until the market close, so we're taking a look at the major averages here. We've got a sell-off going on today here, so bringing to a halt the momentum that we had been seeing as of late that's sort of fading a little bit into the beginning of October. The Dow off by 513 points, so really accelerating to the downside as the day goes on. The S&P off by more than 1%. The Nasdaq off by 1.25%. And again, you see this acceleration to the downside happening over the course of the day. We're watching this closely intertwined with what's happening in the bond market here, with this move upwards above 4% in yields.
Yeah, that's the highest I think we've been, Julie, since I think pretty much, early August. I'm thinking there, which is interesting. I mean, in part what's going on there, of course, stronger than expected jobs report in September. Obviously, a lot of folks betting inflation slowed down, is going to continue to slow down. So perhaps betting the Fed, if they move here, is going to move more cautiously.
Really a resetting of those rate expectations. That's having a ripple effect with the sectors as well. Last week we were talking a little bit about this, the sort of interest rate sensitive groups with yields moving up or moving down. We continue to see that. Utilities, really the prime example of that. Really, this has been the outperformer of the year, up 25%. So seeing some people take profits as we see those yields move higher. We've got consumer discretionary financials also taking a hit here. And then the other big story that we've been watching, Josh and me, has been oil prices. We continue to see oil move higher here. You've got WTI. There's the year to date and the gains that we have seen. But really, over the course of this session, the past few sessions, big move. Brent's back above $80 a barrel.
Yeah, so geopolitics front and center still, right? You're just waiting to see how and when Israel responds after being attacked by Iran. Do they hit Iranian oil fields? And if they did, what would be the economic impact? Julie, what would be the sentiment impact? Just a lot of uncertainty there.
Well, and of course, we should mention today, October 7th, the 1 year anniversary of Hamas's attacks on Israel. And so really forefront of investors' minds today in particular as they await perhaps the next move there.
For sure. All right, let's move on. Friday's surprisingly robust jobs report put a damper on Wall Street's jumbo rate cut bets. According to the CME FedWatch tool, in just 1 week, investors have abandoned the idea of a 50 basis point cut in November, and nearly 15% are now predicting the Fed will leave rates actually unchanged at its next meeting. And our next guest says there's no case for another cut. We're joined now by Torsten Slok, chief economist at Apollo Global Management, parent company, of course, of Yahoo Finance. Torsten, great to see you as always. Let's start, Torsten, state of the economy, that better than expected jobs report we did get, Torsten. I'm curious to get your take on that jobs report, what you made of it, what do you think the Fed made of it?
Well, I think that the economy is actually still doing quite well. The puzzle in financial markets, of course, is that the Federal Reserve started raising interest rates in March of 2022. And we're still sitting here 2.5 years later, and we still have not seen the negative consequences of interest rates moving higher. So that's why the debate looking ahead continues to be about, well, why didn't Fed hikes have this negative impact on the economy? And why is it that the data continues to still be so strong? And there are three reasons for that. First of all, we still have a strong tailwind from energy transition. We still have a strong tailwind also from fiscal policy. And we also still have a strong tailwind because consumers during the pandemic locked in low interest rates and firms locked in low interest rates. So the sensitivity to interest rates going up has just been relatively weak. So I think that the short answer to your question, Josh, is that the economic data is doing quite well. Inflation has come down. That's why the Fed cut rates. But going forward, if the economy is still doing well, that does raise some questions about whether we will see all the Fed cuts that the Fed is expecting at the moment.
Well, Torsten, you were one of the folks at the beginning of the year. You said they might not need to change rates at all, right? You might not see that much of a difference here. You have been talking about the strength in the U.S. economy. What about the argument on the part of the Fed that rather than sort of forestalling weakness in the labor market, they are cutting to normalize, to bring rates back to that sort of neutral level? Is that a valid reason to act? And you mentioned a little bit the risks that could come with that. Can you discuss that a little bit more?
No, you're right, Julie. I mean, it is correct that they used the justification at the last meeting that it wasn't really because the economy was weak. It was more that they were happy with where inflation is. And inflation has come down. It peaked at 9.1% in the summer of 2022. And now it's at 2.5%. So coming from 9 to 2.5%, that is certainly very impressive. And we have come a long way. But the key issue now is, well, if you begin to cut prematurely, it does, of course, raise the risk, in particular for reigniting a rally in the housing market. We're already seeing various indicators on housing beginning to show much more sign of life. And most importantly, the risk, of course, is if home prices begin to go up again. Housing has a weight of 40% in the CPI basket. We could also begin to see inflation begin to move higher. So that's why it's a very delicate balance that they are trying to walk here between, on the one hand, they do want the economic data to be good, but they also don't want inflation to begin to move higher.
Torsten, you mentioned inflation cooling. I want to talk about oil for a second here. I was talking with Julie at the top of the show about this move we're seeing, Torsten, geopolitical risk front and center. Does Israel hit Iranian oil facilities? The move higher we're seeing, Torsten, how as an economist are you thinking through that move and possible ripple effects?
Yeah, so for every $10 increase in oil prices, then inflation, depending on exactly whether you look at core or headline, but broadly speaking, inflation will go up by roughly 0.3%. So that means that the higher oil prices is absolutely going to lift inflation. Headline inflation will, of course, move more because it includes food and energy, but core is likely to also see some increase. So that's why it is certainly a risk on top of the economy beginning to show more strength, as we saw in the employment report on Friday. Most importantly, the unemployment rate moving down is also suggesting with strong wage inflation that we could even on the labor side see some upward pressure on inflation overall. So you're right, Josh. There's a number of different bullet points that are now lining up towards worrying before about, well, hey, maybe inflation is now coming down, to now worrying more about, well, maybe we're coming back into, in the worst case, the 2022 regime where rates were going up and stocks were going down. So in that sense, on Friday, the narrative for the U.S. economy changed 180 degrees from, hey, we're going through a slowdown, to now renewed fears about, well, maybe we should worry about a reacceleration.
Torsten, you mentioned that wage stickiness, and something I've been trying to get at with economists is, has it ever happened that wages have been rising and it hasn't had that much of an upward effect overall on inflation?
You're absolutely right, Julie. That basically never happens. So that's another way of saying, I mean, if we just think about the data, and also now we're about to go into the earnings season, if the data is still strong, if the earnings season is still strong, you can't argue that, oh, then the labor market is weak, but that's just a small thing. No, it must be the case if the economy is strong, then the labor market is also strong. If the economy is weak, well, then the labor market is also weak. And exactly as you're highlighting, if inflation in wages, which now came in at 4.0 on Friday, then we should also expect that to show up in inflation in consumer prices. It is really simple, as usual in economics, that it is really about consistency. What are we seeing in the mosaic of indicators that are coming in, and the mosaic of indicators that they're coming, the totality of the data, as Jay Powell is saying, it is still telling us that inflation is not under control yet, and we still have this risk that the Fed will have to keep rates higher for longer, which continues to be our baseline scenario.
Torsten, I'm curious as we head into this new earnings season here, broadly speaking, how does the consumer look to you, Torsten? Last earnings season, you listened to a lot of CEOs and CFOs on the conference calls. You heard about a consumer that was selective, Torsten, discerning, more focused on what they need rather than what they want. Is that still the trend? Is that still the theme?
I think absolutely, Josh, that there is a lot of nuance when it comes to the consumer. Because if you look at, the stock price of Ferrari being at all-time highs and the stock price of Dollar General being at all-time lows, it really does tell you what's going on, namely that high-end consumers are generally still doing fine because high-end consumers generally own the S&P 500, they generally own their home, and the cash flow they get from their fixed income holdings is still very solid because the level of interest rates is still very high. In private credit, the level of cash flow and the level of yields remains very high relative to what we've seen in the last 20 years. On the other side, you're seeing for low-income households that there is more signs still of delinquency rates going up for credit cards. For low-income households, delinquency rates going up on auto loans. You're also seeing in terms of savings, low-income households are out of savings, whereas high-income households are seeing an increase in their savings. So in short, it is a very bifurcated outlook for the consumer, where net, the result is still that the overall picture for consumption is holding up. When you look at in particular, the weekly data from Redbook resale sales, that tells you that consumers are still doing fine. But you're right, there's a lot of nuances within, in particular, discretionary spending that becomes very much a function of which segment of consumers is it that we're looking at.
And Torsten, overall, when you zoom out and look at corporate profits, and in particular, I know you highlighted in your chart book, corporate profit margins, those weekly forward profit margins, that they're at a record high. And we've heard we've heard people say before, oh, we're getting to peak margins and it's going to roll over. We're getting to peak margins and it's going to roll over. And they did roll over, I guess, in 22, but then they came back. How much is this going to support the further gains in stocks if, all of this other stuff aside, if margins are still growing?
Absolutely. Corporate America is still doing well, and profit margins, as you exactly are highlighting, is indeed at very high levels. So why is this important? Because if we think back to what creates a recession, in 2020, we got a recession because of COVID. That was a big shock. 2008, we got a recession because of Lehman Brothers. Of course, that was a big shock. Prior recession was in 2000, 2001. We saw the S&P go down 50%. That also generated a somewhat mild recession, but it did generate a recession. But if we look at the data and we look at the situation today, there is no similar shock that is hurting corporate earnings. There is no similar shock that's creating a sudden stop in consumption for consumers or a sudden stop in CapEx spending for firms. So broadly speaking, in particular with the Fed now cutting rates, the tailwind from AI, the tailwind also very broadly speaking, of course, also from the energy transition, also very broadly speaking, the tailwinds from CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We still have fairly strong support for U.S. economic growth, and that should, to your question, Julie, also imply that corporate earnings are going to also look well during this earnings season.
We shall see. We'll get them soon enough. Torsten, great to see you. Thank you so much.
Thank you.
We're just getting started here on Market Domination. Coming up, we're taking a look at some of the top names on Yahoo Finance's trending tickers page. Plus, earnings season kicks off on Friday with a slew of results from some of Wall Street's biggest banks. We'll have more on how to best position your portfolio later this hour. And at 3:30 p.m., it's the latest edition of our series, Goodbye or Goodbye. Stick around, we've got much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we've got Supermicro. That stock has been surging today after the company said it's currently shipping more than 100,000 graphics processors per quarter. It also unveiled a new suite of liquid cooling products. The boom in generative artificial intelligence tech has bumped up demand for the hardware required to process the large amounts of data that Gen AI uses, which has been benefiting Supermicro. Also, maybe something of a relief rally here as well. The stock's been hit by recent sort of investigations into its accounting. It's off about 60% from the record high it reached back in March.
Yeah, I saw Barron's estimating that this is billions of dollars in orders. And also Bloomberg saying the data suggests customer demand is robust, has been dented, they say, by the company's internal stumbles, such as a 10K filing delay and reported U.S. probe, referring there to reports late last month, Julie. The DOJ is looking into an ex-employee's claims that SMCI violated accounting rules. So to your point, though, nice pop in today's trade.
Yes.
All right, moving on to our next trending ticker, Generac. Shares of the generator maker soaring today, up about 8% there. It's after Hurricane Helene devastated the Southwest, and with Category 5 Hurricane Milton rapidly now approaching Florida. So Milton intensifying, Julie, reports that this storm could spark the largest evacuation in 7 years as it aims for the state's Gulf Coast and Tampa. So you do see different moves in the market. We're showing there some insurance stocks coming under pressure. Heritage Insurance, I saw American Coastal Insurance. I did see analysts cite as saying we could see substantial losses. The landfall is expected to be in the more densely populated West Coast of the state. Helene, of course, hit the Panhandle.
Yes, but I mean, if there is going to be overlap, that then sort of compounds the issue for insurers in particular. Generac tends to see a boost at times like this when you do see these storms bearing down. Even if people don't have time to buy a generator now, the thinking is it will spark the idea that they want to have a generator for the next storm that comes through. I was actually texting with my cousin in Florida just a little while ago. She lives in Tampa, and it sounds like they are battening down the hatches in preparation for this storm. So some of the insurers affected more than others. Everest, which is an insurer, is the worst performer in the S&P 500 today.
I did see analysts at Canaccord Genuity. Now, they like Generac. They were telling their clients, as we await Milton, Helene, they said, had a durable impact. While we see some potential for upside to Generac's previous guidance, they told them that, listen, we're waiting for additional detail from management around their international trends before they make any adjustments to their estimates.
Yeah. All right, and one more mover for you. That is Air Products and Chemicals. That stock is moving higher today. Now, last week, the Wall Street Journal revealed that activist investor Mantle Ridge had built up $1 billion stake in the industrial gas supplier and was planning a push for improvements. That report then prompted a number of analyst commentaries. Jefferies, for example, upgraded the stock to buy from hold, boosted its price target to 364 from 295. Also, Evercore ISI and Vertical Research also raising the recommendations for the stock.
Yeah, everybody was jumping in. Citi, which has a buy, opened a 90-day positive catalyst watch, telling their clients we see the activist involvement as a first step in APD realizing the value of its core business and de-risking both current and future energy transition opportunities. Stock is now about 35% so far this year.
All right. And then overall, we're looking at a very different picture than some of these individual movers. Stocks are slipping today. Wall Street struggling to keep the momentum from Friday's rally amid headwinds from rising rates and higher oil prices. Joining us now for more, Dennis DeBusschere, who's 22V Research President. Dennis, it's good to see you here. So on Friday, we had sort of the good news is good news vibe. Today, as people sort of reset their rate expectations, it feels different. What do you think's going on here?
Yeah, it does feel a little different. I think the speed of the move in treasuries is a little bit concerning to people. But I would just keep in mind that there's no reason to believe that the current level of economic growth, which is roughly around 2.5% if you take the Atlanta Fed's GDP nowcast at a face value, is something that's going to lead to higher inflation. Just keep in mind that we've gone from very high inflation to the current levels of inflation with about the same growth that we have now. The labor market has eased. So there's no reason, unless CPI really shocks to the upside, to expect that rates will just keep on gapping higher because of some inflation risk. Rates are going up because recession tail risks are lower. That's a good thing. Generally, that's risk positive, meaning rates and stocks are positively correlated. It is concerning, though, if you see oil gapping up 3% plus a day on geopolitical concerns, your pre-election in October, which, who knows happens, typically very weak period, and you see rates gapping up day to day. So I guess that combination of events is a headwind, but I wouldn't say it's because people are all of a sudden fearful that inflation is going to run away from you.
Let me ask you, Dennis, get your take. We did get that stronger than expected jobs report last week. The economy seems to be holding up here. Is your base case a soft landing?
Yes. I mean, soft landing, no landing. I mean, you've never really seen a sharp deceleration in economic growth. There was concerns about that. Companies have talked about that. It has not showed up in the data. So, yeah, our base case is a soft landing, and we're more worried about higher inflation than lower inflation related to a recession. So our base case is a soft landing. It's been that way for a long time, which typically is very good for, say, cyclicals relative to defensives.
And so talk us through that a little bit more. Why does that tend to be better for cyclicals than defensives here? It seems like, even though a lot of people talk about this view that they do believe in the soft landing, if you look at something like the Citi Economic Surprise Index, the data keeps surprising to the upside. So even if they believe in the soft landing, it feels like the data is coming in even better than people think.
Yeah, so stronger data is good for cyclicals. I mean, they're more economically sensitive. That's very bad for defensives. So when I say defensives, just to be clear, I'm thinking staples, pharma, to some extent utilities, although utilities kind of have an AI/electrification play to them these days. But the classic defensives that are not as economically sensitive would lag relative to cyclicals that are economically sensitive. So if you're surprising positively on Citi Surprise, the data is coming in at 3%-ish on underlying demand. Recession tail risk is much lower because payroll is solid. That's a very good backdrop for cyclicals. It does suggest, by the way, stronger earnings growth next year. Like economic growth forecasts will be revised higher for 2025 and 2026. I think that's a pretty easy call to make now.
Dennis, and for those cyclicals, how does valuation look? I ask because we've had strategists come on, and just for the market broadly, you'll ask them how valuation looks, and one recently told us it looks a bit unnerving, in his opinion. How do you see it?
Broadly speaking, cyclicals relative to defensives are not concerning. I mean, you're at basically, I think, just about the 50th percentile on your next 12-month multiple for cyclical relative to defensives, which is fine because you have such stronger earnings growth in cyclicals. But to your point, valuations across the board are higher than normal. That's kind of a separate argument about whether or not the entire market is overvalued. I don't think it is, but that's a fair enough statement to make, I guess. But on a relative basis, cyclicals are not overly expensive relative to defensives.
When you talk about valuation zones, the sort of delicacy that brings sometimes, something else you wrote about in a recent note is short-term tail risk, meaning the risk of heading into the election and the volatility that can bring to the market. How should investors be thinking about that, and how should they be sort of preparing for that positioning in the market?
Yeah, it's a great question. So just to step back, typically during October, in pre-election periods, you have unusual weakness in the market. And then, very strong markets, unusually so in November, December, once you get through that clearing event. So first and foremost, there's a lot of tail risk hedging going on based on the unknown, based on the potential bad outcome, based on, maybe we don't figure out the election until January of next year or something. That if we actually have something done the day after the election, you should expect significant relief in markets. That's really important. But we're not going to trade great into it because, who knows? These elections the last, few times have been, let's just say, less than clear the day after. And there's been a lot of excitement around them. So not positive excitement, obviously. So that's what the hedging is about. And I would assume if you have a relatively clean result, you should see a relief rally immediately.
Dennis, let's go overseas as well. Chinese authorities taking steps to boost their economy. You saw Chinese equities rip on that, Dennis. Were you excited about those moves?
Yeah, I was pretty excited. We were actually in China 2 weeks ago as those announcements were rolling out, doing a trip there. And I was certainly impressed by the willingness, it seems, by authorities to support the market. We could argue about how much the impact of stimulus will have on the actual economy, but it's very clear coming out of from an authoritative point of view that they think that supporting the stock market and obviously supporting property prices is critical to turning confidence. So in the Chinese economy and consumer confidence in particular. So you should probably expect support for the market, Chinese market going forward. I think it's a very tough fade.
Dennis, great to have you on the show today. Thank you so much for joining us.
Thank you.
And coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at utilities. That's after the sector saw a shining third quarter. I'm here with Anthony Crowdell. He is Mizuho America's Managing Director and Senior Utilities Analyst. Anthony, thank you so much for being here. Utilities have been on fire this year, as we know, in part because of the outlook for rates to go down and in part because of data center demand, of course. So let's get to it, and the stock that you like, which is Pinnacle West. Now, this stock's done pretty well, along with the rest of utilities. It's up about 21% this year, about 20% over the past 12 months. So let's get to why you think it's got further upside. It's based in Arizona, Phoenix, Arizona. And you say regulation there is improving. How is it improving?
Sure. So if you think of utilities, the biggest thing is state regulation, up 20%, or I think for the year, that's unutility-like. But regulation matters, especially in the state houses. Arizona's been a challenging jurisdiction for a number of years. We've seen a changeover in the commission there, and they're now looking at ways to help the utility, what we call under-earn, looking for ways to minimize the under-earning utilities facing. And so we think they're going to have approval maybe we call it a policy statement, maybe later this year. And we think this is going to give a continued momentum on this story, and we continue to look for PNW at Pinnacle West to outperform throughout the year and beginning in 2025.
So it's not necessarily that the rates are going higher, it's that they can capture more.
Basically capture more. I mean, if we went to like Utility 101, if you think about a utility is able to earn an ROE or return on equity, and say it's a 10% right now, we'll just use roughly right now, the average is about 9.7. So if a utility is able to earn 9.7, there's different reasons why they typically under-earn. A lot of times it's based on a historical test year, or they're looking at expenses from the previous year. And what's happening right now is the regulation is real, the regulators are realizing that we need to help the utilities get to their allowed return. And so they're creating mechanisms that will help the utility. We may look at formula rates or forward test year, we may call it, to help them hit that 10% ROE. And that's what we mean by improving regulation. It will help the utility earn a better return, but it's not necessarily changing the cost per the customer.
Yeah, I think we need to learn more about utilities, considering how well they've done this year. So it's good to learn a little bit more. And on continuing on that thread, attractive load growth. What are we talking about here?
Yeah, so we went through 15, 20 years where there was no load growth in our sector. I mean, basically how much additional electricity you're selling each year. If you think of booming Manhattan, I think their load growth for the last 10 years was somewhere between 0.5%.
Wow.
So efficiencies, we have these LED lightings, we have these sensors that turn off the lights in our office as soon as we leave. That's really weighed down on the number of units that a utility sells. All of a sudden, bam, what happens? We get a pandemic, we get a lot of relocation going on to the communities like Phoenix, Arizona, and then we get this great tailwind of data centers, this onshore of manufacturing, and all that is helping utilities in certain locations sell a lot more units. Pinnacle West, their load growth, again, we talked about Manhattan would be about between 0.5%. They're seeing load growth about 5%.
Gotcha.
So for a utility, that is just
a lot.
A lot's a great way, yes.
And then there's the valuation here. So it is trading at a premium, but not at a huge one.
Right, so we think that this premium is very understated, meaning that, correct, like you say, it's not a huge one. I mean, we think this should go up, but also what we think, because of this additional load growth, because of the ability for the company maybe to minimize that under-earning, we maybe in 2026, and utility people do look out 2 or 3 years, we could see a step change in their earnings growth that makes this premium more of an inline or maybe a slight discount. So you're playing for 1 December, hopefully we get a catalyst that they're going to give us this regulatory lag docket or policy statement. Then we're looking for, as we work our way through 2025, when the focus becomes 2026, on do we get a change or a step change in their earnings growth rate.
Gotcha. So we always like to point out a potential risk with these guys. And so in this case, it is just like the upside regulation, the downside could be regulated.
Yeah, that's the good and bad or the boring side of utilities. It really all comes down to, a lot of it comes down to regulation or their state houses. I mean, a lot of times people call me up, hey, what's going to happen with this presidential election? I mean, we're more focused on the state house elections. Making matters even more challenging in Arizona is the utility regulators, there's 5 of them, they're publicly elected. A lot of other states, they're appointed by a governor, so you do have to follow small local elections going on with the regulators there. We believe right now there's 5 commissioners. Right now it's about, I think it's 3 Republicans, 2 Democrats. We think you'll have a similar mix, or if not more Republicans on the commission, and we think that this momentum will continue, helping Pinnacle West minimize their under-earning.
All right, let's get to the stocks that you think folks should avoid right now. This one's done well this year too. It's First Energy, based in Akron, Ohio. It's also up around the same amount year to date. This too, we're talking about regulation.
Right, yeah, we're talking regulation again.
And rates.
And rate, right, and so this is, I don't know if it's a void, it's something we really want to be cautious of. And the reason is we don't know how state regulation is going to work out here. As we talk about Pinnacle West, we think we're seeing regulation changing for the better. We're not sure if Ohio, if the regulation for First Energy is changing for the worse. The reason we say that is the previous management team had been involved in some bribery cases with the regulator. They're no longer with the company. There's a whole new management team in there. We talk about they've done a big change in the management, but will the regulators give a punitive decision or a more balanced decision? What we've seen in our space is that first rate case you have, or the utility has, after something has gone haywire like this, It's been more of a punitive decision. And so it's such a binary call in First Energy in Ohio. If the regulators are supportive of the company, if they're going to give them a balanced decision, this would be an attractive name. We're not ready to say that just yet. And we think since this rate case will play out at least 12 months, it's probably something you want to stay on the sidelines before you jump in.
Well, it's interesting because, as you say, it's new management. They have settled. They've paid fines. And so this punitive rate decision would be on top of that.
I mean, you bring up the buy thesis on it. I mean, we get called a lot, and investors looking to pitch this as a buy to us. We're more cautious and saying, hey, new management team, they've paid their fines. They're going to base a decision on the record. The company's invested a lot of capital in the state, and they should get an adequate return on it. But so far, we've seen more punitive decisions come out from regulators following an event that happened here. So we're not ready to say that things are going to be fine here. We want investors to avoid this or stay on the sidelines until we get a decision.
So if they don't get the good decision, what happens to the balance sheet?
Well, they don't get the decision. That's the risk here. The balance sheet is more concerned that the operating companies, the utilities, what we like to call opcos for the utility nerdos out there. I mean, if you look at the opcos of the utilities, some of the opcos, especially in Ohio, I think 2 or 3 of them have more of a challenging balance sheet. One of them has a FFO to debt metric of 5%. If you think of an average metric for a utility, it's probably somewhere 15 to 20%. So if you get a challenging decision, you could see the company have to maybe push more equity down to these opcos, and that would be now we get into the decision of how they're going to fund that. Do they fund that with additional debt, or do they fund that with additional equity? Again, it matters how punitive this decision, just a inline decision or not that favorable decision. I don't think we're going to see anything like that. But should we get a very punitive decision from the Ohio regulators, you could see the company having to downstream some equity there.
Right.
It's more of a minor risk, but it's something we think is baked into the company. Right now, it trades at a 13% discount, and we don't think we see changes to that discount until we get clarity over Ohio.
And by the way, for folks who are not utilities nerds, FFO, funds from operations.
That's it. You got it.
And then the risk is obviously to the upside. The thing that could go right is that it goes their way.
Yeah, we talk about it. It's trading at a 13% discount. They're growing earnings 6 to 8%. The dividend is solid, and you have a new management team that investors really respond to. You get a good decision to pick up a company growing 6 to 8% at a 13% discount. This name you could see re-rate to a group average multiple. We're not ready to say that yet because it's so binary, this Ohio rate case.
And real quick, when is it expected?
It's expected later in 2025. So that's the problem. You're kind of on the sidelines for a while, which that long-term catalyst keeps us even more comfortable with being on the sidelines of the story.
Gotcha. All right, thank you so much.
Bet,
really
Julie.
appreciate it, Anthony. Interesting stuff on a very closely watched industry right now. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
Let's get to some calls of the day now. UBS upgrading NXP Semiconductors from neutral to buy, the note highlighting healthy inventory and pricing. So NXP, the global semiconductor company, UBS does get bullish on this one. The target goes to 285. Yes, the analyst says the auto backdrop is challenging here, but they say the derating in shares, it's unwarranted in their opinion. They do talk about new data suggesting, they say, healthy inventory and pricing supportive of a 2025 recovery, Julie.
Yeah, and they're looking at basically the company's margins to improve after troughing. So that's something to keep an eye on here.
They say best-in-class margins, resilience. NXP trades at its largest ever discount to U.S. peers also.
Oh, that's interesting. Yeah. All right, let's also talk about Tesla. Of course, we're all watching Tesla this week, and Bernstein's out with a new note on the company, laying out 10 key questions ahead of the company's much-anticipated robo-taxi event on Thursday, 10/10. We've been looking forward to this one. Now, we should note, Tony Sacconaghi, the analyst here, has an underperform on Tesla with a $120 price target. So that would be half of what it is right now. So that's the context here. And he points out there is a lot of uncertainty about what we're going to see. He thinks that Tesla is already behind some of the other robo-taxi players out there, and that's one of the reasons that he's not ready to be impressed by this event.
No, he isn't. Quite that. It says this event, he told clients, will be long on vision, Julie, and short on immediate deliverables. Suspects this is going to be a sell the news event, he says, consistent with most Tesla announcements historically. Not looking for much time.
I mean, they are about vision, but sometimes that makes the stock continue to go higher. So that's, You never know what that's.
And well, you got Tony's take. That's Tony's take.
Yes, although Tom Narayan also had a similar-ish take when we spoke to him about Tesla as well, where he wasn't sure how much concrete was going to happen on that day itself, and that the robotaxi fully coming to fruition would be further in the future. But he's more of a bull than Tony.
For sure.
So that's important to note. Well, a U.S. judge on Monday ordering Google to restructure its mobile app store to open the service up to competition. Yahoo Finance's Dan Halley joined us now to explain, and obviously a lot going on legally with the likes of Alphabet and some of the other tech giants. So break this one down for us, Dan.
Yeah, Julie, this is part of that Epic Games lawsuit that Google had lost. And this is basically the judge saying, look, now you have to open up your platform for third-party app stores and provide users with another means of paying outside of going through Google's own payment methods. And so this is something that is likely to kind of reverberate across the tech ecosystem, potentially also with Apple. Now, Apple had a similar lawsuit with Epic. They ended up kind of getting a draw, more or less. They had to provide a means for people to be able to purchase apps outside of just Apple's own service, but they don't necessarily have to add additional stores similar to what Google has to do here. In the UK, or EU rather, Apple has to open up to third-party stores, but in the US, not necessarily. So this is going to be a big change for Google itself. They already do offer a means to install third-party stores, but it's not exactly easy. They make it so that there's all sorts of warnings and stuff before you sign in to kind of scare you a little bit and just stick with the Play Store. But now it appears as though they're going to be forced to make this change.
And Dan, switching gears a bit here, we have reports of a possible release date for the highly anticipated Apple Intelligence features. What can you tell us there?
Yeah, this is according to Bloomberg's Mark Gurman saying that on October 28th, Apple will make the release of Apple Intelligence, the software that they've been using to promote the iPhone 16 line, but isn't available yet. So, I'm sure you've seen the commercials constantly of Apple Intelligence. The Fifth Avenue store flagship in Manhattan is decked out with Apple Intelligence. Fonts and stuff like that lit up like the new version of Siri is going to be lit up, but it's just not available yet. And so the 28th is when people should start getting access to portions of Apple Intelligence. The company's been very clear saying that they're going to continue to roll it out throughout the year and 2025. So don't expect to see the updated Siri just yet. Really what you're going to get is things like summarizing mail, summarizing notifications. Some of them can be very helpful when you're have long lines of texts. You have updates for sports or news, things like that. You don't want to look at a bunch of different notifications. You can just see, okay, here's the summarization of it. Some of them can be just downright ridiculous. I've seen them where they've had really if you're having a sarcastic conversation with someone going back and forth or a group of friends, it's not gonna interpret the sarcasm very well, and you'll have some really strange summarizations. But you'll also get likely priority mail in your email, as well as summarizations for emails and things along those lines, as well as some of those writing tools that Apple's talked about. But the new version of Siri, that's going to take a while to come, and so is ChatGPT integration.
All right, Dan, thank you. Appreciate it. And coming up, big banks kick off the next round of earnings this Friday. We're taking a look at which are best positioned in our investor playbook when market domination returns. The Fed slashing interest rates by 50 basis points in its last meeting. We're looking at what that means for banks as we kick off earnings season, which are best positioned to take advantage of lower rates and which will be hit the hardest, and where should investors be looking for value. With just a few minutes left till the closing bell on Wall Street, we're navigating how to play the bank sector with the Yahoo Finance Playbook. And joining us now is Devin Ryan, Director of Financial Technology Research at Citizens JMP. Devin, always great to see you.
Great to see you.
So let's start there, Devin. So the Fed delivers that supersized cut, surprised a few folks. What does that mean for your coverage universe in terms of ripple effects, loan growth, CRE, M&A?
Yeah, it means a lot. We've been kind of waiting for this, right? So we've been talking about the Fed lowering rates for the better part of the past year, and we finally got the first cut, and it was more than I think some people thought out of the gate. So there's a lot of implications on balance sheets. I think clearly, securities yields and some of the, what you earn on your cash on the asset side of the equation is going to come down a little bit. But the flip side is the deposit costs are going to come down as well, especially this really high cost funding. So when I look at my coverage, some of the names that I think are really well situated for this are Charles Schwab. So they've been a name that's been pretty hard hit and kind of underperforming over the last year or so here. And even though on one hand, they are going to see a little bit of a lower asset yield on some of their short-term stuff, the longer-term securities are rolling off and they're going to reprice higher. And then they have this funding cost dynamic where customer essentially cash deposits have been going out the door to money markets, and I think that's going to stop as well. So I think that's a pretty important dynamic for them. And then you also hit on something as well, Josh, the capital markets. So capital markets have been very depressed. We put out a note today on kind of M&A trends and looking at the industry activity, and we see about 30% upside just to kind of getting back to historical trend line. And that's going to happen as a catalyst off of the back of rates coming down. Sponsors are going to get more active in the market. Companies' financing is going to come down, so they're going to be more active in M&A. So we're pretty constructive there as well. So anything kind of capital markets centric. And so, large investment banks, Goldman Sachs has been a name that we've highlighted. And so I think that'd be another one that I would look at here.
All of that said, a lot of these stocks have done really well. If you look at the XLF, which looks at all of the financials, it's up like 20% this year. So how much of what you're discussing has already been priced into these stocks?
Yeah, Joe, it's a great question, and I think the short answer is a lot. I think the question is good news good enough from here? And I think you have to be super selective after the moves that we've seen over the last really year. A lot of the capital markets names that I cover are up 50 to 100%. Some of the alternative asset managers are up even more than that. So we want to be selective. That being said, I think there's still some really good opportunities. So Goldman Sachs, I mentioned that's been a great stock, but now the story is moving to the next leg, which I think is asset management. You're going to hear me talk more about that because they've built out a pretty big alternative asset management business. The alternative asset managers trade at 25 times or more on forward earnings. So as that part of their business becomes more meaningful, that's going to move the needle. I think on the smaller cap side, a name Perella Weinberg, it's a small advisory boutique trading at 13 times our estimate for next year. The peers are over 20 times, so I think they're going to close that valuation gap. So there's a lot of upside still there. And then I mentioned Schwab on the kind of the interest rate side, and then a firm LPL Financial, which is a wealth management firm, the largest independent firm.
Yeah, they've been having some troubles recently, right? They just fired their CEO.
Yeah, so they just had obviously a little bit of disruption at the top with their CEO being terminated for cause. That being said, we know their interim CEO very well, and feel really comfortable about the management team there and just the overall story. There's been some things that I think for all these rates names, there's so much nuance to kind of modeling out what lower rates means. And so LPL has been a name that I think has been a little bit hard hit because people have been confused around what lower rates mean for them. I think we have a differentiated call on this where I actually think that as rates move lower, they have a lot of capacity to lower the deposit cost side. And so that will offset really all the headwind of lower rates. So I think they'll kind of be neutral there. And I don't think that's what the market's pricing in right now. So I still see a pretty good opportunity there.
Devin, the economy's been holding in there. Do I have to believe in that soft landing story before I would commit capital to a lot of your names?
Yeah, I think you need to believe in that for the market. Like, where are risk assets right now, and what is being baked into the broader market? And the S&P, forward multiples, the highest level it's been in a really long time. So I think that tells you that the market's a little bit expensive, and that right now, generally, that soft landing I think is the base case. So when I look at my stocks, I'm always looking for where's the risk reward. So what is the downside case if I'm wrong and that soft landing doesn't play out, versus what am I getting on the positive side if that soft landing plays out? And so I want to find good risk rewards, not just high upside, right? And so the names that I just referenced there, I think, are ones where there's a good risk reward, where if I'm wrong and the market rolls over, yeah, they're going to have some downside, but I don't think they're getting priced to perfection, whereas a lot of other capital markets names have really, they're baking in to Julie's point, the really rosy scenario of a recovery. So I do think you need that soft landing for stocks. Financials are obviously a little bit more economic sensitive, so maybe even a little bit more so.
Let's also talk about some of the more, on the more fintech side of the equation, some of the more buzzy stocks like a Robinhood or a Coinbase. What are the implications of rate cuts for that? I mean, you would think off the top of your head that it would be positive if there is monetary stimulus for those companies. Is that how it is going to play out, do you think?
Yeah, so I think it will play out that way, but actually, Robinhood is a good example. I think that the market is looking at Robinhood as actually a firm that could get hurt a little bit by lower rates, and the reason being is that some of the assets will reprice. So they have a lot of corporate cash, they have a lot of customer cash in the balance sheet, they have margin balances. All those will come down a little bit in pricing. The company even said on their earnings call last quarter that a 25 basis point cut is about 40 million impacted them. I'll take the other side of that. There's actually a lot of positive offsets that people don't really focus on. So positive offsets would be margin balances are going to accelerate quite a bit because risk-on behavior is going to have people take out more margin. Securities lending, when capital markets pick up, generally that recovers. That's an area that I actually think will largely offset that even $40 million that I just mentioned. So Robinhood, I think people are looking at it as they're going to get hurt by lower rates. I'd actually argue they're going to be able to withstand them pretty well, and that's part of our thesis on the stock, that there's some misunderstanding on that.
All right, gotta leave it there. Devin, a lot of ideas for people to think about going into earnings season. Great to see you.
Great to see you guys. Yeah, thanks so much.
In. Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That's the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let us start with where the major averages ended the day. Near the lows is the short answer to that question. Down nearly 400 points on the Dow, 398, almost 1% here. A little teeny baby bounce off the bottom at the end of the day after that rally that we had on Friday. Now, interestingly, so-called good news was good news on Friday. In other words, a stronger than expected jobs report buoyed stocks and risk assets pretty broadly. Today, as we see investors taking another look at the rate cut odds going forward, they're not seeing another 0.5 percentage point cut at the next meeting. And some investors and traders are even discounting the odds of maybe no cut happening. So all of that seeming to weigh on stocks today. The S&P down 1% as well, and the Nasdaq Composite down about 1.2%. And we're seeing the equal weight and the small caps fall as well. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. It looks like we're snapping a 4-day streak for the majors here. A little bit of a downdraft to begin the week, but I've been focused on the VIX, and I'm going to show you a 3-month chart. You can see we have now risen above the September peak right here, at least on a closing basis. This one right here, that was August 5th. On an intraday, got all the way up into the 60s. But my point is, volatility is on the rise. So higher high means we might see a little turnaround in stocks, but I would still mention that we are very, very close to record highs right now. Here's a candlestick chart, and you can see we are still above the old breakout area, and that's really key right here. Dauer didn't move much today. Did want to check in on the 10-year T-note yield. That is up another 4 basis points to 4.03%. So above that big psychological point, 4%. Could mean something to investors, especially if it goes higher. And we're seeing a little bit of negative price action today. That may be a little bit of the cause. Only energy finished in the green. We've seen crude oil really on a tear recently, up from significant lows. And then the worst performer today was utilities. That was down about 2 1/3%. Consumer discretionary, communication services, and financials, all of those down by more than 1%. So pretty broad-based decline, except for those energy stocks. And included in that is TAN. Solar is actually the best performer of the day. Crypto got a little bit of love. That's GBTC. Chinese stocks operating on their own agenda. I'll check on them real quickly. Here we can see Alibaba up 2%, but kind of a mixed board. Bilibili down 4%. And I did want to check out as well the energy sector, because I've been tracking ExxonMobil, which has been at record highs. I believe it notched an intraday on the open. And here's a field of green here. And let me just show you what's happened over the last month. Not a lot of outsized performance, but it has been one of the bright spots when we've seen a lot of down days like we are today. And I'll just go back. I'm going to close on this. I want to show you the energy chart. XLE. On a max basis, we are up by near the record highs. And we've touched this level before. If we finally break through, probably got a lot of momentum, but this could take days, it could take hours, or even months to play out. So we'll see how that goes. Josh?
Thank you, Jared. A tough start to the week on Wall Street. The Dow pulling back from a record high as the 10-year yield ends above 4% for the first time since late July. And joining us now is Nancy Tangler, Laffer Tangler Investments CEO and CIO. Nancy, always great to have you on the show. Let's start there with that benchmark 10-year, Nancy, back above 4%. What do you make of that move, Nancy? And where do you see that yield headed from here?
Thanks for having me, Josh. It's great to be here. Our bond team had expected rates to back up again. And so we're not at all surprised by this. Clearly, the market got well ahead of the Fed and super enthusiastic about multiple 50 basis point cuts. But we just don't, we're in an environment where we don't think we needed the first one necessarily, maybe a 25 basis point cut, because the economy is still sound and the job market is not falling apart. So we would expect to see rates climb a little bit more, and then we'll extend duration and hang in there for a bit.
Hey, Nancy, it's Julie here. We've been talking with people all day about the repercussions of the Fed's 50 basis point cut that they did. Where are you putting the risks of inflation sort of reigniting, given that we saw them do that?
I'm concerned about it, Julie. I mean, I think you've seen the pressure, the upward pressure on energy prices and materials after China announced stimulus. We know that shelter has not declined and remains pretty elevated. And so when the Fed looks at core PCE, they're taking out the very things that most Americans consume in mass, and the majority of their disposable income. So we're concerned base effects get harder going into November. And so we do think we're going to get a tick up. And the question will be how much and how sustainable it is. But it is definitely on our radar, something that we're watching.
I want to talk to you, Nancy, about another big theme today, which was oil rising again in today's trade. Geopolitical risk is front and center there, Nancy. How are you thinking through potential consequences here? Obviously, investors are wondering how and when Israel responds to this Israel attack Iranian oil facilities. How are you thinking as a strategist about that in terms of potential economic fallout, sentiment fallout?
Yeah. So, Josh, I think one of the things people hate about Wall Street is that we tend to have a perverse reaction to crises. And so historically, when we've entered into geopolitical periods of tension or war, what we've seen is the market rally after the fact. And so I think you have to be aware of this has been going on for a long time. We've got two war fronts. And so I think you certainly have to be hedged for it. But generally speaking, it has not hurt stocks, just like insurance stocks often go up after major storms or hurricanes. That's all I can say about it, is that it's probably a bullish opportunity a few months out, and then we'll have the election behind us as well.
Nancy, let's get to some specific picks here. You know, given the sort of turbulent backdrop that we're talking about, one of your picks that stands out to me is Amazon, and that's in part because it actually got a downgrade today. Wells Fargo downgrading the stock. It's unusual. It doesn't have too many bears out there right now, or at least even neutrals out there, but the analyst saying that the company is doing well in cloud, but that's not enough to offset some of the margin pressures in other parts of the business. You like Amazon, so I guess tell us why he's not right.
Yeah, well, and one of the things that he cited was Walmart, which has been the poster child of our investing theme, old economy companies embracing new technologies and pivoting to those new technologies. But I think one of the things you have to be aware of with Amazon is that this for us is a 3 to 5 year investment. Their advertising business is accelerating. The cloud business could in fact be sufficient. And we really haven't seen weakness in the online shopping business. They're hiring about the same amount of holiday workers as they did last year. So we think Andy Jassy is one of the better operators in the corporate America. And so we're willing to give them the benefit of the doubt as we go into the end of the year. Prime Day, as you know, starts tomorrow, I think. And so we'll be watching that, of course, but this is in our 12 best ideas portfolio. And all of the names that I gave you are names that fit our theme of, and a theme is, an investing theme is not a trade. It's a 3 to 5 year commitment. And that's what that's one of the reasons we like Amazon.
Now, usually, Nancy, when you're on, we always take a beat and talk about Broadcom and the great Hock Tan. But here's another one you like, Oracle, which has had a remarkable run this year. It's up about 60%. Another name that's become one of your favorites, Nancy?
We've owned it for a long time, Josh. It's the largest holding in TGLR, our ETF. And we think they're in the sweet spot of being able to provide on-premise cloud computing, doing so in a way that's compatible with all the other providers. When I got into the business, we used to make bets on Oracle stock based on what, whether Larry Ellison was sailing with the America's Cup or back home in the office. He cannot be underestimated, and his influence is still intact at that company. Safra Catz is a great CEO, so we continue to like it here. It's not terribly expensive, so we'll be in the stock for a while.
And then finally, sticking with tech, let's talk about AMD for a moment here. Obviously, NVIDIA gets a lot of the headlines, but AMD has its fans as well, and you're one of them. So do you like it? I would ask first, do you like it versus NVIDIA? Do you own NVIDIA also? Or, how do you think about those two?
So we own, as you know, have owned Broadcom. We called it the poor man's NVIDIA. During this summer tech swoon, we added into the portfolios and initiated a very small position in NVIDIA. Basically, AMD just needs to get NVIDIA's table scraps to generate $2 to $4 billion in revenue growth in the coming years. So we think Lisa Su's a great operator. She's taking a page out of their NVIDIA's playbook. And so as demand continues to grow, and we think it will continue to grow for these chips, she will be able to take more share with AMD's offering. So it's just a different way to play it, and we like it very much.
Nancy, great to see you. Take care.
Thank you.
Thanks.
Thank you.
Let's turn our attention to Boeing now. That stock ending the day slightly higher, up nearly about 0.5%. Today, the aerospace giant restarted talks with its machinists. They've been on strike for more than 3 weeks, and that work stoppage has halted production of Boeing's 777, 767, and its 737 MAX jet. The economic impact of over 30,000 workers walking off the job continues to grow, with analysts from Oxford Economics comparing it to Hurricane Helene. That strike is Boeing's first since 2008, and the company is set to report its third quarter earnings before the bell on October 23rd. So the pressure is on. Boeing had tried to go directly to the workers, sort of cutting the union out effectively.
30% general wage increase.
Exactly, and it didn't work.
No, it did not.
So now the parties appear to be back to the table.
There's apparently been little direct contact between the two parties, and now you're entering a fourth week. Bloomberg pointed out, listen, if you're a union member, you actually haven't been paid now since September 19th. Boeing, of course, also has some pressure, credit rating agencies sitting on its shoulder.
Yeah.
Do they cut the rein to junk? So is that enough of encouragement from both sides to maybe work something out this time?
Well, you shall see.
We should. All right, shares of DJT soaring in today's trade. Find out why next when market domination over time returns. Shares of Trump media surging on Monday after Elon Musk made an appearance at Donald Trump's rally in Pennsylvania over the weekend. And Yahoo Finance's Alexandra Canal joins us now with more. Allie.
Hi, Josh. Yeah, and as you're seeing, shares of DJT closing more than 10% higher today. Like you mentioned, Elon Musk continuing to show his support for Donald Trump, this time at his rally in Butler, Pennsylvania. Remember, this was the location where Trump survived an assassination attempt back in July. So Trump looking to regain some of that momentum that we saw over the summer, especially as the polls are pretty much neck and neck between the former president and the current vice president and Democratic nominee, Kamala Harris. At Saturday's rally, Musk told the crowd that Trump is the only candidate who can, quote, preserve democracy in America, adding that this will be the last election if Trump does not win. Now, as we saw Elon Musk show support for Donald Trump, we also saw Kamala Harris make a slew of media appearances over the weekend. She did appear in an episode of Call Her Daddy with Alexandra Cooper. That is a podcast catered towards Gen Z, along with an episode of 60 Minutes. But DJT as a stock, it's very volatile. It often fluctuates based on the news cycle, whether or not it's positive or negative headlines when it comes to Donald Trump. He maintains a roughly 60% interest in DJT, and at current levels of around $19 a share in the after-hours trading, Trump Media boasts a market cap of about $3.8 billion. That gives the former president a stake worth around $2.3 billion. But right after this company did make its public debut on the Nasdaq in March, Trump's stake was worth well over $4.5 billion. So a significant decrease there. We're down about 70% from those highs that we saw earlier in the spring. Trump, at this point, he can sell those shares, although he has said that he has no plans to do that and that he uses Truth Social as a means of getting out his word. But again, very volatile stock, operates very much like a meme stock. I'm sure it's going to continue to be volatile the closer that we get to that November election.
I'm sure you're right about that. Thanks a lot, Allie. Appreciate it. Well, the national debt has not been mentioned much by either former President Donald Trump or Vice President Kamala Harris during this election cycle, but ignoring it doesn't mean that it goes away. Joining us now to break down how each candidate's plans would affect the debt is Maya McGinnis, Committee for Responsible Federal Budget President. The organization out with a new assessment, trying to figure out how much each candidate's plans would add to the debt. Maya, thank you so much for being here.
Yeah, thank you.
So the short answer is a lot. Trump more than Harris, right? How do you kind of suss this out given the amorphous nature sometimes of campaign promises and plans?
Yeah, 100%. So we know a couple things. One, that campaigns always focus on the giveaways, the goodies, the tax cuts and the spending increases, and they're going to be less specific on how they would pay for those plans, if they would pay for those plans. And second, the details aren't all fleshed out. Some of them have tons of details and spreadsheets. Others are kind of whimsical throwaway lines. So we go through and we look at every promise from the campaign. Hopefully they've put it in writing. We have conversations with the campaigns. But in the end, we have big ranges of what the candidates would do to the overall fiscal situation of the country. And the bottom line, of course, is that our fiscal situation is in terrible shape. We're going to hit the record debt levels soon. The fastest growing part of our budget is interest payments. Neither candidate has a plan or even a proposal to bring those debt levels down. Within the range of candidate Harris, she has on the very lowest range not making the debt any worse, and the highest range as much as $8 trillion, which is a significant contribution. From former President Trump, we're looking at numbers basically twice as high. So we're talking about trillions of dollars in all likelihood from both of these sets of proposals, more so for Trump, but neither of them with an overall plan to reduce the debt, which is at this point where we are in our fiscal situation, absolutely what is necessary.
So Maya, what about entitlements specifically? What do we hear from Trump and Harris in terms of how they're going to shore up Medicare, Social Security?
Not much. Thank you for asking that question because it barely gets mentioned in the campaign. The two biggest government programs, Social Security and Medicare, both have trust funds that are headed towards insolvency. And when that happens, there will be across-the-board benefit cuts for Social Security for all current retirees and beneficiaries, and across-the-board provider cuts for Medicare, meaning there'll be less medical care available. And instead of addressing those very real, very significant problems, we have both candidates promising not to touch benefits for any retiree. And that's supposed to be reassuring. But I promise you, if you're somebody who's on Social Security and you know that in roughly a decade, you're going to have across the board benefit cuts of 20%, there's nothing reassuring about that. And it's also not leadership. We know these problems exist. Just look at the trustees report. There are many ways to fix them, but we should have the people who want to be the leader of this country talking about how they would do so instead of kind of a pander race to out demagogue and out compete each other on scaring seniors and taking things off the table instead of putting out real proposals with some details of how to address these very important problems.
Well, Maya, if history is any indication, they won't solve the problem until they have to, right? I mean, that's kind of how, not to be cynical, but that's kind of how Washington works with a lot of situations. So, I mean, could you argue that if we sort of acknowledge the reality of that and just say, okay, they'll deal with it when the cuts are on the threshold of happening? What would that look like?
The problem with that is with these intergenerational programs where we're paying into the programs today and they're supporting retirees today. If you wait until the last minute, the solutions become significantly larger. So it used to be that a decade ago or so, you could lift the payroll tax cap, for instance, and that would have fixed Social Security. Today, it would only fix a fraction of the program. Secondly, a lot of these changes we would make, you want to phase in gradually. You want retirees to know what to expect. And we could say, okay, life expectancies are longer. We're going to raise the retirement age for younger people, and we're not even going to start it for 10 years. But if you wait until we're basically not able to send out checks, those same changes won't make as much of a dent and improvement, and people won't have the warning. So I think it's absolutely the wrong way to do it, and we shouldn't let political cowardice lead us into bad policy solutions that are much more painful for the people most affected.
Maya, more near term, spinning ahead to 2025, how important is that to whoever is going to eventually move into the White House? In terms of fiscal policy, Maya, what's on the calendar next year?
2025 is going to be a huge year. It's going to kick off in January with the return of the debt ceiling. We'll have a number of months where they don't deal with it and they shuffle around some money in trust funds with extraordinary measures. But we are going to have to lift that debt ceiling. And the question is, will we, as we did last time, attach some kind of fiscal improvements along with lifting it, which makes sense. There should be no threat of default, but we should come up with fiscal improvements. Or will they, as in past years, actually include additional legislation that would make the debt worse? So there's some big choices to make there. Secondly, there's the expiration of the Trump tax cuts. Both Republicans and Democrats are talking about extending the bulk of these tax cuts, either all of them in the case of Trump and then some, or most of them for everybody under $400,000 in the case of Harris. These are very expensive, and the clear requirement, or should be here, how are you going to offset the cost so they don't add $4 or $5 trillion to the debt? So big questions. Also, the spending caps that exist right now will be ending. They should figure out a way to extend those, and really, they should put in place a bipartisan fiscal commission or a plan to deal with this debt, because the most important thing we could do now is put in place a debt plan, and whoever is president guarantee that they will not borrow for their proposals, but they'll figure out a way for paying for any of the new proposals that they want to pay and put in place.
Maya, finally, as you well know, there's a strain of thought out there that says it's okay if the U.S. carries this kind of debt load because the other nations of the world, individuals, institutions, they're still willing to lend us that money and at pretty attractive rates to boot. So what's your argument against that? I know we've talked about this before, but for folks who are kind of paying attention to sort of these various arguments about it.
It's so dangerous to say that this doesn't matter. And it's sort of a hard argument to make after we just came off of a moment where we had very high inflation, higher interest rates, and we saw that with higher interest rates, we have massive increases in our interest payments. So because of that bump up in interest rates we just endured, we now have interest payments as the fastest growing part of our budget, the second largest item in our budget, larger than defense, larger than all spending on children at the federal level, squeezing out parts of the budget. So it's already causing massive damage to our budgetary situation and it's slowing our economic growth at a time we should be figuring out how to improve economic growth. So it's not as though there's going to be a crisis. It slowly chips away at our economic strength, our standard of living, and even our national security. So people who make arguments you don't need to worry about it are lulling us into a much, much weaker country, which in some ways we already have from all the debt we've borrowed in the past, and it's on track to become much, much worse. You can't be an honest leader with the American people without explaining that you cannot borrow your way to security or prosperity. We have to make changes.
Maya, it's a big, important topic. Thank you for taking the time to help us walk through it. Appreciate it.
Thank you so much.
Time now for To Watch Tuesday, October 8th. We're going to start off on the Fed. We'll get a big round of Fed commentary tomorrow throughout the day. That includes Fed Presidents Raphael Bostic and Susan Collins. This coming after Bostic told Reuters last week that he's open to another large rate cut if the job market weakens. With the September jobs report coming in much stronger than expected, Wall Street will listen to how the Atlanta Fed president feels now.
Taking a look at the labor market, the monthly NFIB Small Business Optimism Index for September is coming out in the morning. Economists forecast that number will tick up to 92 compared to last month. The new data giving us more insight into how lower rates have affected small businesses.
And on the earnings front, Pepsi reporting third quarter earnings in the morning. Analysts saying that slowing price increases could drive organic sales growth.
And finally, General Motors is having its Investor Day tomorrow afternoon in Tennessee. It's been 2 years since its last one. Investors will be eager to hear company commentary as the automaker is facing slower consumer demand. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a tough day on Wall Street. The Dow pulling back from a record high as rising Treasury yields weigh on equities. The 10-year yield topping 4% since August. Also rising oil prices weighing on sentiment. Plus, a make-or-break day for Tesla and CEO Elon Musk looms. We're just days away now from the company's robo-taxi event. What it means for the stock, that's ahead. While the port strike is over for now, one of the key sticking points remains automation. We look at what the union is asking for and whether dock workers should really be worried about the threat from robots. Tesla's robotaxi day is coming up on Thursday. Our next guest says this could be a make or break moment for CEO Elon Musk. Here to talk about his article is Al Root, associate editor at Barron's. Al, it's always great to have you on the show. So robotaxi day, it's here, Al. It's finally here. What is your kind of expectations, Al, of what Elon Musk is going to say? Do you think there's actually, baseline expectation, what he has to say at this event?
Yeah. Hi, Josh. Good to see you again. I think 5 things, right? I've been saying sort of 5 things. Unveil a physical robotaxi, right? We want to see the car. Talk about safety data, right? There's a lot of talk about Tesla's approach versus Waymo's and FSD, their driver assistance product that gets sold today to consumers, and if that's good enough to turn these into robotaxis. So we'll need a deep dive into safety data. We'll need to hear about the business model, where they want to license it, how big they want their fleet of robotaxis to be. We'll need to hear some timing, right? I put it this way, Tesla expects to launch a driverless car in Austin, Texas by, the fourth quarter of 2025. I think that's sort of the base expectation. And then maybe something a little extra. A lot of people think we'll see, the lower price so-called Model 2 that's due in early 2025. Maybe that'll make an appearance. And maybe an update about the robot called Optimist. But that's sort of the list of items you can tick to see if they're doing a good job or a bad job. But make no mistake, it is sort of a big deal for the company, and it's about furthering this AI narrative and showing that Tesla deserves to be in the Mag 7, not compared to Ford and General Motors.
You mentioned Tesla versus Waymo there, which is interesting. Now, how does Musk's approach this technology? How does it sort of compare and contrast to Waymo?
Well, this might be one of the great debates that I've covered at my time at Barron's, right? So robo-taxis are here, right? You go to Phoenix, LA, San Francisco. Waymo does more than 100,000 self-driving cab rides a week now. These are commercial vehicles, purpose-built, $100,000 to $200,000, lots of hardware, lots of sensors, of course, lots of software. And they didn't, put them on the roads until they were fully ready to be self-driving, right? And that's their approach. Sensors, modest move across the country. Tesla, on the other hand, is trying to make its driver assistance software. It calls the highest level software full self-drive. You pay $99 a month. I've used it. I pay $99 a month occasionally. And they're trying to basically incrementally improve that into turning Teslas into self-driving cars. Now, Tesla argues we've got millions of cars giving us data. We have billions of miles driven with full self-drive on, yet they've never done a single official autonomous cab ride. Waymo has. So it's sort of like, you tell me, which approach do you like better? One feels a little safer. One feels a little more Muskian. And that's the way Tesla has gone.
You also, in your very good column, Al, you talk about how with this event, the possibility that you also, beyond Musk and Tesla, does it raise awareness of kind of robo-taxi tech more broadly? And does it create this kind of halo effect for other names? Talk about that.
Yeah, I think it does. I mean, it's difficult to say what's in various stocks and what it could do for the industry. I think the first time we wrote like a self-driving cover story at Barron's, I think it was 2021, right? And, all of these stocks, Aptiv and maybe Mobileye, back in the day that was part of Intel, could benefit. And, it feels like 3 years later, not a lot's happened, but then you do sort of get the Waymo experience. And now Tesla's hosting effectively what is, its third artificial intelligence day. This time it's sort of, demonstrating the applications, self-driving cars from its AI dominance. Things are changing and things are here. I think that the 2 or 3 stocks aside from Tesla that benefit the most, one is Apple, right? Because what is Apple? One is Alphabet. I wish it still was Google. You think about Waymo's valuation, YouTube's valuation inside of Alphabet, and you're going to get all of these notes about what the opportunity is. RBC notably calls Tesla's robotaxi opportunity $600 billion worth of market value, and basically its target price, the way it does it. Adam Jonas, we know $310 price target. 70-80% of that price target is non-automotive businesses. So these are hundreds of billions of dollars, and it's not going to take a lot for someone to look at Alphabet and say, $600-700 billion. What is Waymo, reflected in the stock right now? Oh, probably not so much. Now, Alphabet has its own issues, right? Antitrust concerns and things like that. But Alphabet, and then the other two are Uber and Lyft. Really, they're the users of this technology. Whether Tesla becomes a competitor, whether they use Teslas, the expansion of robotaxis across the country will benefit the network players. And I'd like to point out that Uber is worth more than Ford, General Motors, and Stellantis combined, right? The users of the technology tend to be worth more than the hardware producers, which is one reason Tesla wants to do this. So those are sort of the stocks I would look at to move around on Robotaxi Day. So it's more than just Tesla.
Finally, I want to get your take on another name you know very well, GM, Investor Day tomorrow, CEO Mary Barra. What do you think we're going to hear there, Al, about EVs, hybrids, and their own Cruise autonomous vehicle unit?
Yeah, so Cruise, let's go AVs and keep on the theme, and we'll go backwards. So Cruise lost its license to be a self-driving car company about a year ago. October 2023 feels like it wasn't a year ago, but there was the unfortunate incident. A Cruise vehicle dragged someone in San Francisco, and California suspended the license. So we need a pathway forward, right? So Uber Technologies has partnered with GM, plans to buy Cruise autonomous taxis, integrate them into their fleet. So things are still happening. So I would like to hear sort of, we plan to get our license back, by this date. We're all in with Uber. Here's the business model. It's modified a little bit. All the changes we've made to improve our safety data. So that's one of the 2 or 3 or maybe 4 things that's very important for GM to review. And then the other things, hear about electric vehicle plans. Electric vehicles actually making a bit of a comeback in Q3, still growing, not as fast. What that means for investment. As important to any of that is just the state of the auto market. Traditional auto stocks sort of had a terrible quarter as everybody sort of feared the slowing economy and slowing sales. We had just a terrible guidance from Stellantis, which took the wind out of everybody's sales. So you're also going to get a really important update just sort of about the state of the U.S. consumer and selling cars here. And then finally, we'll want to see if they can continue to buy back all the stock they've been buying back. General Motors, pretty good stock this year, mostly because they bought $16 billion worth of stock back over the last few months. Very impressive of me.
Al, always great to have you on the show. Thank you for joining us. Appreciate it.
Thanks. Busy week.
Stocks closing lower as Wall Street struggles to sustain momentum following Friday's jobs report rally. Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Josh.
Hey, Josh, I want to start with the moves that we've seen in the 10-year Treasury yield. So we back above 4% for the first time since August. And I just want to chart out that action here for us, Josh, and take a look at what we've been seeing. So you can see the big move up we got Friday post that jobs report. This is largely investors speculating perhaps that rates might stay higher for longer with this largely surprising jobs report coming in better than expected. Maybe the Fed doesn't cut as much as we initially thought, right? So a little bit of repricing there. If I zoom out here over the last couple months, you can see we see a big jump up here after really the trend had been lower for yields. And I point this out because when you look at sort of where people are speculating on what the Fed's going to do, it's interesting. This is actually 15% odds that the market's pricing that the Fed doesn't cut it all in November. Remember, a week ago, we were looking at maybe a 30% chance of a 50 basis point cut. So this gives you a sense of sort of why yields are rising right now and kind of that debate shifting back to, are we getting a no landing, where the economy keeps growing more than expected. It's actually maybe an inflation concern. The Fed doesn't cut at all. And what does that mean for stocks? That seems to be kind of an open question right now. After we had that rally Friday, stocks lower today as yields kept moving higher.
If you look at the benchmark 10-year, so back over 4%, is there a level strategists look at and say that is a level that threatens the stock market?
Yeah, so it seems like 4.25 had been a level before that people were looking at, right? Like if we go in between the 4 to 4.25 range, maybe that's okay. Then once we zoom out and get, if I go year to date, we should be able to see when it's been higher. Yeah, so remember here, stock market was challenged here right at 4.5. That was our drawdown in April. And so I think you could probably call that a key level again. At basically, essentially, I think Michael Cantor has put this well to think about this for investors. As yields go up, it might just be a little bit more risk off in the market, meaning you need to own more quality stocks that are going to have good earnings coming up in this earnings season. So as yields continue, if they continue to chug higher, you're going to hear a lot more strategists talking about quality and kind of staying up in solid companies rather than maybe getting more speculative and getting that kind of everything rally that we've seen a little bit over the past couple of years.
All right, Schaefer, bullet point number 2.
Number 2, we're going to stick with interest rates, right? So interest rate sensitive stocks have been taking a back seat over the last couple of days, and that is counter to the action we have been seeing, Josh. So we have been talking over the past couple months about, okay, rates are going to come lower, Fed's going to cut. If I look at the 2-month here, we'll see what's outperformed. Actually, sorry, I'll even go 6 months. So you can see utilities, real estate. People see those, you think interest rate trades, right? Rates are coming down. That's good for those 2 sectors. Now we just talked about rates might be higher than people thought. Look at the market action over the last 2 days. Worst performing sectors, real estate, utilities. So kind of that interest rate trade not really doing great. And then you even zoom out to, I'll pull up the Russell 2000 for us, also kind of a speculative play in terms of interest rates, right? Normally rates come down. This index has done better. Today, not really the case. So you look here, maybe higher for longer. Russell 2000's rally that we saw on Friday sort of takes a pause. It'll be interesting to see how investors sort of digest what to do with small caps.
How many strategists have come on the show and pounded the table for small caps? Because they would say, listen, the economy's holding in there, dovish Fed. That was the thesis.
It was interesting. In a note last night, Laurie Calvasino from RBC said, so the easy part of the small caps trade might be over, right? So we've seen a rally here throughout the year, and that's like you said, Josh, people have been calling for small caps. And that's because when you zoom out over the last couple of years, it hasn't done nearly as well as the index. So really what the call was small caps are undervalued, small caps have a catch-up to make. She thinks that catch-up has already happened. Now the question is, for small caps to run higher, is the economy really doing better than we thought? If the economy is doing better than we thought, that's usually a good backdrop for small caps, but it seems like the looming questions over how strong is this stronger than expected economy might be what keeps small caps on hold for a little bit here.
All right, thank you, Joshua. Appreciate it. U.S. workers feeling the potential risks of automation. We're going to dive into how it's shaping union negotiations on asking for a trend next. Automation hitting a speed bump in the U.S. The contentious issue of port automation remains a sore spot for the International Longshoremen Union. The ILA is still negotiating the issue amid its tentative agreement to suspend the port workers' strike. As the new strike clock counts down, we're looking at the progress of automation in the U.S. with University of Richmond professor Sheetal Dekti. Sheetal, it is good to see you. So let's dig into this issue of automation. So we have the two sides. They've worked out some parts about this, but they're still negotiating on this question of port automation. What's at stake in this issue, and how do you actually see it playing out?
Yeah, a lot of the dialogue around the port strike is on efficiencies and the use of automation in ways that can replace workers. And I feel that the argument has been very narrow in that there are many other considerations. For example, the past few weeks, past few months, decades have shown us that extreme events and atypical working conditions are prevalent. We're seeing that with the natural disasters happening recently with the hurricanes, wildfires, extreme heat, and generally unsafe working conditions. And the potential is that the AI and the technology can actually help improve health and safety of workers, which is incredibly important. And I feel that's generally missing in a lot of the dialogue that we're seeing.
But I guess, the worry about for some of these workers is that the technology is actually going to replace them.
Yes, and there are many numbers out there. So I am not an expert on the numbers or the number of jobs that may be lost or how the job titles may change. But the reality is across professions, my profession, your profession, across the board, there's an increased need for AI literacy, and that AI technological literacy is not just how to use tools, but it's also to understand the benefits of those tools, when and where they're appropriate, and also potential downsides and things that we need to be aware of and concerned of. And it's very natural, and it's incredibly valid for anyone to be concerned about any new technology, whether it's AI related or not, especially when those technologies are in the early stages of regulation. Trust in technologies, it happens over time, and it happens with experience and through meaningful dialogue among stakeholders. And it doesn't just happen overnight. And, you think back to the Windows paperclip, Clippy from many decades ago. It was an annoying tool, but it evolved over time into something like Alexa and Siri that we use today. And so, this isn't just about workers and jobs, though those are very important and, incredibly critical concerns within the conversation. But this is also a question of just technology and trust in that technology.
One expression I've heard, Sheetal, is folks say, ultimately how this is going to play out is it's not AI that's going to take your job. It's somebody who knows how to use AI that's going to take your job. You think there's any truth to that, or too simplistic?
It is very true. AI is here. It's not going away. And the AI, the norms of it and the best practices of it today are going to be very different from, a year from now and decades from now. And it's our job within these rapidly changing technologies to be ever vigilant and ever aware of what's happening on the technological landscape.
How do we make sure, Sheetal, that the most people possible benefit from that technology?
Yeah, well, the most people can benefit from a technology when it's carried out in ethical and trustworthy ways. And I can't say what the end result is many decades from now, but what we have to do in the near term is take steps aware that we have to balance many different objectives and concerns in the meantime and let the technology evolve. Technology is not just like a light switch. It's either on or off, but little changes happen over time. And we need to make sure that those little changes are stakeholder informed and done in ethical ways.
You brought up, last question, Sheetal. You brought up an interesting question, which is that with this port strike, you have both sides now at the table, and they're talking and apparently debating this issue of port automation. What's interesting about that to me is that automation technology you know, it's evolving, obviously. It's constantly changing. I mean, the automation today will look different than 5 years today, 10 years today. So how do you actually negotiate that?
Yeah, what you have to negotiate is possibly points in time in which that negotiation gets reevaluated. Nobody, you know, not even experts today know what the landscape is going to look like. And so making careful consideration of the timeline of renegotiation will be critical.
Chantal, thank you so much for joining us. Appreciate your input.
Thank you very much.
And coming up, our chart of the day when asking for a trend returns right on the other side. For our chart of the day, we're looking at the S&P 500 versus the Citi Economic Surprise Index. And Yahoo Finance's Julie Hyman joins you now with a closer look. Julie.
Hey, Josh, indeed. So the Citi Economic Surprise Index, which is the blue line here, it moves higher if economic reports are beating estimates and lower if they're missing them. And this here is the zero line. So if it is above the line, it means more reports are beating than missing. If it's below, well, it means the opposite. And what you've seen here is that while we had some missing of economic data going into sort of the first half of this year, really in the past month and a half, we've seen a big increase here. The rate of change has really improved, as Charles Schwab's Kevin Gordon pointed out on X. And so that has meant that economic data is coming in better than expected, and that has translated into good news for stocks as well. Now, for a while, the narrative was, well, bad news was good news for stocks because it implied that the Fed would be quicker to cut rates. But now, with the economic report that we got on Friday, of course, the jobs report coming in better than estimated and stocks moving higher, that challenges that narrative to some extent. And really, that's been what we've been seeing recently, perhaps today's action notwithstanding. We talked earlier to Dennis DeBuscher about this, of 22V Research, about the trend that we have seen in this index and what it could mean going forward.
So if you're surprising positively on Citi Surprise, the data is coming in at 3%-ish on underlying demand. Recession tail risk is much lower because payroll is solid. That's a very good backdrop for cyclicals. It does suggest, by the way, stronger earnings growth next year. Like economic growth forecasts will be revised higher for 2025 and 2026.
That was an interesting point he made, that we're going to continue to see this filter through to economic projections going ahead for the next couple of years. And also, of course, Josh, he told us that he likes cyclicals in this environment, that is, stocks of companies that are more sort of economically sensitive and maybe can benefit more if we continue to see the economic numbers come in as they have.
All right, Julie, thanks for that. Appreciate it. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.